Hello friends, welcome to another episode of Finspirations 9, the channel that leads you from finance, economics and money to wealth. That is FEM to W. And I am Sunil Thakker. We will take up today's topic after this message. Today's topic is a contrarian indicator, the stock market files. Before we try to understand how the stock market behaves towards public discontentment, let us comprehend each term to gauge the impact. Let us begin with the misery index. What is a misery index and how is it measured? The misery index provides a snapshot of a nation's economy. It was first created by the American economist Arthur Oken during 1970s. Oken is known as the father of the misery index. He took the simple sum of the nation's annual inflation rate and the unemployment rate to provide an easily understood look at the economy's relative health. Basically, the higher the index, the more misery was felt by the average citizens. But the Oken's index was found to be a flawed gauge of the economic conditions experienced by the average citizen because it doesn't include economic growth data. And the prevalence of low inflation and low unemployment figures across much of the world also means that the utility of Oken's index is limited. Over the years, the misery index has been modified several times. Today, it includes bank lending rates and economic growth data. In 2011, Johns Hopkins economist Steve Hanke applied this to the countries beyond the United States. Hanke's modified annual misery index is the sum of the unemployment rate, the inflation rate, and the bank lending rates minus the change in the real gross domestic product or GDP per capita. Even asset classes have created their own misery index, like the Bitcoin misery index. Yes. On your screen, you can now see the misery index graph from 1989 till today. That's 2023. This graph shows that during September 2019, the misery index had bottomed to a near all-time low at 5.2%. However, just 6 months later, in April 2020, due to the COVID-19 shutdown and consequent high unemployment, the index shot up to 15.03%. This brief but severe pandemic-driven recession sent the index to its highest level since the early 1980s. But then, as employment picked up, which means unemployment rates dropped, but inflation surfaced. You can see that in April 2023, the misery index is at 7.4%. This is just below the post-1989 median of 8.1%. Let us now understand what is consumer sentiment. Consumer sentiment is a measure that predicts recession and the trajectory of the economy. In short, it is an economic indicator that measures how optimistic consumers feel about their finances and the state of the economy. In other words, it takes into account people's feeling towards their current financial health. It takes into account the health of the economy in the short term. It also takes into account the prospects for longer term economic growth. And finally, it is widely considered to be a useful economic indicator. Which means To measure the consumer sentiment, people are asked, is now a good time to buy a house or later? Or is now a good time to buy a car or later? Are interest rates going up in a way that I should get a loan now so that I don't have to pay the higher interest rates in the future? If people are confident about the future, they are likely to shop more, boosting the economy. In contrast, when consumers are uncertain about what lies ahead, they tend to save money and make fewer discretionary purchases. Let us now look at how the Consumer Sentiment Index behaved from 1989 till today, 2023. I'll put up the graph on the screen for you to just have a look. Consumer sentiment plummeted, reaching its low point in October 1990. A decade later, in 2000, as the new millennium commenced, the technology stock crash began. The consumer sentiment declined in troughs until October 2008 for nearly 8 years. Fast forward to another decade, to 2020. With the advent of coronavirus, sentiment crashed. That is when inflation hit us hard, and you can see from the graph that today the consumer sentiment is near its 35-year low. Let us now look at how the Dow Jones behaved in these 35 years and whether we can see the silver lining on the horizon. Gloomy sentiments obviously make people deeply pessimistic. However, there is a silver lining for equity investors. Such sombre moods have typically presaged strong stock market gains. We saw from the 35-year pattern from both the misery index and the consumer sentiment index, and from this Dow Jones graph, that when people's sentiments are at a rock bottom, stocks are likely to thrive because the economic damage that bothers them has already occurred. On the other hand, when people are contented, it is equivalent to a red herring. In other words, equity investors, be warned. In conclusion, there is a saying on Wall Street that when your cabbie talks of the world falling apart or gives you stock tips, watch out. When consumer sentiment is low, it is a good sign for stocks. Though the adage is, misery loves company, the contrarian theory is true here. When the public is gloomy, equities usually thrive. The common claim that consumer confidence is inversely related to stock performance is correct. So friends, hope you have learned much from this video, and if you have, do subscribe, comment and share this widely. In our next video, we will discuss what is inflation and how it can be beneficial to us. Until then, stay inspired.